Hey, Brett, how's it going this week?
Good, Ange. How are you?
Good. Well, that means it's another episode of Money in the Bank, the personal finance podcast. And we talk about all things personal finance related and more, right?
That's right.
So, are you ready for your trivia question this week?
Yeah, we always do those.
All right. So, this is an easy one. True or false? It's better to pay off your mortgage and invest the Or wait, hold on. Let me rephrase that. Is it better to pay off your mortgage faster or take that extra money and invest the difference?
Trick question. It probably depends.
True, but what's the general answer for most people?
I think from the lessons learned that we've had, I would say the answer is probably to invest the money rather than pay down your mortgage as fast as possible.
Correct. So, welcome to the podcast titled Don't Pay Off Your Mortgage. So, I like to say that we offer mathematically sound financial advice instead of the other financial gurus out there that just try to make people feel good about their life decisions.
Right? I mean, that's one strategy. Making people feel empowered makes them act and makes them make decisions, but usually they don't stick around for a long term, right?
Yeah.
When you teach somebody how to manage their finances correctly, then that's a long-term behavior that they take with them forever.
So I say let's do both, right? Let's get people financially empowered and let's get them making the best decision possible. So this podcast, actually, this idea came to me for two reasons. One is that we got a email recently from a listener who was asking whether she should pay off her student loans or invest in an IRA. So as I was helping her crunch the numbers, it became very evident that in the long term, she would benefit more if she invested in an IRA. And then this also came about because, as I've mentioned before, I'm a big fan of Mr. Money Mustache, and I like to get on those forums. And one of my favorite comrades on there, B42, has argued this point until his face went blue. So, in honor of B42 and our podcast emailer, we get this episode.
And this is also a great episode for us specifically because we have had the opposite mindset.
Right.
Early on in our, advanced finance planning career when we got our first house and, we were aggressively against debt and, all those regular things, we were in that mentality. But as we've learned and as we've gone through this process, and crunched the numbers for years, we've flipped our opinion on this and we now believe we're on the right choice.
Yeah, so let's start with an example to get the shock value out there, and then we can talk more about, the emotional side versus the financial side. But pure numbers, let's say you have a 30-year mortgage for $200,000. I just picked kind of a average mortgage balance in the U.S., and obviously that can vary greatly, but $200,000, 30-year mortgage at 4%, okay? Mm-hmm. And let's say you have the idea of, okay, I'm going to get that paid off in 15 years instead of 30. That would take an extra $500 a month. If you invest that $500 a month instead, I'm assuming 7% interest, which is historical average, very safe interest rate to assume. In 30 years' times, if you paid off the house in 15 years, you'll save $70,000 of interest, which is amazing, right?
Yeah, right. That's where they get you.
Right. So you could have that $70,000 difference, or if you keep the mortgage the entire time and you invest that difference, you will gain $360,000.
Wow.
So, that's a huge difference. And I think the point I'm trying to get across is this can make such a big impact on your total financial picture that it's something you really need to think about, because a lot of people say, oh, well, I want the peace of mind of paying off a house. But actually, investing the difference can give you a bigger peace of mind, because let's say in 15 years you lose your job. You still have that money invested that you could pull out and pay off your house and still have a little bit left over. Where if you pay off your house and then you lose your job, you don't have that cushion to fall back on.
Right, because all your money, and this is what we found out when we looked ahead at what our future looked like, right? 15 years. All our money was tied up in the equity of our house, and that doesn't do anything for you, right? Yeah, great, you own the house outright, but that money's not giving you any kind of a return other than hopefully your house appreciates in the market you live in.
Right. And the only really benefit you see is not having to pay your mortgage payment every month. But ultimately, whatever. Because if you invest that, what we found kind of crunching our numbers is if we invested that money instead, that money would generate enough interest a year to pay for our mortgage.
Right.
So we could pay for our mortgage forever by investing the difference after a certain point, of course. But I think that's kind of the beauty of investing is like getting that compound interest and recognizing those gains. And then, I think the other thing people say is, oh, well, the market is uncertain, so I better not put my money in there. Did you know that the longest kind of down market ever, the longest it's ever taken for the market to recover back to where it was 4 years? Well, that's a hell of a lot shorter than a 30-year mortgage.
Right.
So
I mean, even people that are like nearing the retirement age, right, and they're backing things off, right, they're going to be a little bit more careful. But when you're in the home buying process and you have 30 more years to pay on the mortgage, right, usually people in their upper 60s or mid to upper 60s are not starting that process then, right? It's people that have a long time to be able to sit in the market and accrue all that interest and make this decision appropriately.
Exactly. So why don't we hop in our time machine and go back to when we bought our first house and we decided to pay aggressively and maybe talk about some of those reasons why. And I think a big reason why we paid more on our first house is we knew that it wasn't our forever home. We wanted to get a PMI to drop off, and we wanted to use that kind of as a savings vehicle for our next house. And I would say ultimately we stayed in that house for 3 years, which isn't a very large time horizon. And we ended up, the money we got out of from selling that house, we really did roll into a down payment for our next house. And It's not like we put an insane amount down. We put 20% down. And so that I feel like was kind of a good decision for us. But at the same time, when we bought our first house, we only put 5 or 10% down in the first place. So we wanted to save more money in a very liquid account to be able to, have a down payment into another 3 years. So that was kind of a unique situation where, maybe it kind of made sense.
And yeah, it made sense a little bit. We got a little bit lucky that the market upturned and we were able to sell our house for, equivalent to what we put into it right out of that first house and roll it into this one, right? We didn't take a loss or anything because of a big downturn or anything. So keeping all things equal, yeah, we were able to make a good decision there.
Right. So then we bought our second house and we still actually made higher payments on our house for a full year almost that we lived here. And I think that was a very emotional thing for us. We wanted to own our house free and clear.
Right. And this was coming off of you were paying off your car and we were trying to eliminate all debt. And right, mortgage is a huge debt. Right? It's the biggest debt most people have in their life. Right.
And paying it off felt good.
Right. And we were like, wow, look at how much money we can like throw at this and look at, watch the interest just fall off that we owe, and every time we put another like $1,000 down or $500 down a month, it just eliminates so much future payment for us. Right. That's a really cool thing to look at. But yeah, you're so intoxicated by that, benefit that you don't look at the other side, right? What other things could I be doing with this money? Because it's such a huge amount. Right, it's the biggest monthly payment most people have, right?
Right.
It's the longest term debt people have, right? Other than long-term loan sharks or whatever. But right, so it's a major factor in people's lives, so you have to pay attention to it rather than what we're talking about is like, no, we actually want you to like look away from that and be like just treat it as like a regular thing. Eat all the interest, right, that they try and, tack onto it, at the beginning of the loan and invest the extra money that you would be doubling down on this or adding every month to it. And you're going to come out farther ahead.
Yeah. And so let's talk about why a little bit, maybe. Mortgage rates have been at an all-time low. So if you've gotten a mortgage, I would say in the last 7 years-ish, you very likely have a mortgage rate probably even under 4% and probably definitely under 5%, which is insane, right? I mean, I knew people getting mortgages at one point for in the 2%. We have a mortgage in the low 3% range, right? And now I think the mortgage rate is closer to 4% because interest rates are on the rise. So what does this mean that interest rates are on the rise? Well, it means that, sure, loan rates are going to go up, but also saving rates are going to go up. So like there might come a day with interest rates rising where you can actually get a, CD or a savings account for 3%. So like that's crazy because that's what your mortgage rate is at. So you can like invest your money in a super safe option for literally the same that your mortgage is, because that's the benefit of locking into a 30-year mortgage, is that rate's never going to change. It's an inflation protected asset. So the goal is to hold on to that for as long as possible because you're just getting all of these benefits. Now, what are some, loans that don't fall into that category? Credit card debt, potentially auto loans, depending on the interest rate. I know some people with auto loans that are between 6 and 8%, and if they're that high, you should probably pay them down. I know people with student loans that are 7%, which is kind of a wash, right? If that's our reinvestment rate, then you're probably better off paying that loan down.
Right, because then you buy opportunity that you don't have that debt, which gives you more freedom later.
Right. Sure. So, but for mortgages, because it's such a long time period and the rates have been so low, it makes complete and absolute sense in almost every situation to invest the difference.
Yep.
Now, who might not this make sense for? And this is kind of a gray area. Potentially people nearing retirement. Let's say you're in your 60s and you just got a brand new house and you have a 30-year mortgage. I don't know that you should be paying a mortgage into your 90s. I mean, that's kind of insane, right? Mm-hmm. So potentially you might want to rethink that strategy. But on the same hand, or on the same token, investing that money in the long run will still actually yield better results than, paying it down. So if you did make that decision of buying a new house in your 60s, the math is still the same. If you're going to hold a 30-year mortgage, it is still the right answer to hold that mortgage and invest the difference to build up that rainy day fund we talked about, where if things go south and your retirement plan isn't as good as you thought, you have that, kind of additional buffer that's still generating interest to help you pay the mortgage. So, if you make that decision in your 60s, like you don't get to be super ultra conservative, right? Mm-hmm. But I would say a lot of people nearing retirement like the idea of a paid off house. So that's kind of different. But this is really kind of geared towards people still in their working careers, maybe kind of anyone between, I would say, 20 buying their very first house up through, people in their 40s for sure, and maybe even early 50s. You will definitely yield better results by investing the difference to the tune of $300,000 30 years later, which is an insane amount of money that could really help you in your retirement.
Right. I mean, that's a whole nother house, right?
It's a whole, yeah. Or, it's the 4% rule is kind of what we always talk about as a safe withdrawal rate. So that's going to generate an extra $12,000 a year for you forever. Mm-hmm. Right? And that's insane. I mean, that's awesome. So a $12,000 a year is $1,000 a month. That could be a mortgage payment.
Yep. Or just fun money at that point.
Yeah, or just like
because you're gonna be in your retirement. So
pizza. I mean, I would love to meet somebody who spends $1,000 on pizza a month. Actually, like what pizza money? No. But yeah, or like think about retirement, $12,000 a year. That could be like super awesome vacation fund, right? Mm-hmm.
Or reinvest and just keep making money until you need to take it out, and then you get even more, and it just pays for early retirement. Right, that's another one of our goals, right? So
exactly,
add it to your early retirement fund and start paying yourself out that. So one of the, as I said in the beginning, it depends on the situation. Our current situation and our current economic market allows for this to happen, right? Mortgage rates are, around 4%, for in our area, and right with a return of 7%. That math totally works out to be able to make this equation happen, right? But I know that when I was a kid, when my aunt and uncle built their first house, the mortgage rate that they got was like 14, almost 15%, something like that. And in hindsight, they just should not have built a house, right? They should not have, absolutely, with that kind of a mortgage rate, should not have had a mortgage at that point, and they should have just rented. But But right in that kind of a market, obviously, that's a terrible equation.
Well, so you're also talking about the 80s when interest rates were as high as the hair. So that's like a whole different environment because savings account rates were also like 8% guaranteed.
Yeah, I mean, when I was
the market was earning like 30% a year, right? Well, probably not that high, but I mean, it was very different times. So I'm not talking about the 80s. I'm talking about our current environment. And one other big caveat is I'm talking about the United States. So the other reason this works out really well here is and this might have changed with the new tax laws, so don't quote me on this, but in the past, mortgage interest rate has been deductible on your taxes, and student loan interest for that matter. But also, we have the rates that are low, and we have the investment potential. Now, I know we have a lot of foreign listeners, so I don't want to do a blanket statement for everybody because rates could vary wildly where you are, which is why I kind of mentioned, like, if your, interest rate is 5% or under, this is something you should strongly be considering. In that 5 to 7% range, you should kind of look at the numbers yourself. And anything over than 7%, you should probably be paying off your debt. That's just kind of a good, like, sniff test. But I also know, so there's certain countries where the interest rate is definitely much higher than we have here, and it's actually less advantageous to invest because you get taxed much higher on any dividends gained. Mm-hmm. So the climate in other countries makes it sometimes much more feasible to pay off debt instead of invest. And that's a fair point. So check your own kind of country's laws. But then there are certain countries that actually offer like interest-free mortgage loans. So that exists as well. So if you're in that environment, then right, that's great because that's free money.
Right. Well, even in that scenario, it's still better to definitely invest because you're not paying any of the interest.
Yeah, that's what I'm saying. Yeah. So there's two kind of sides to the coin. There's definitely some countries where probably even more so you should be investing. But then I know there's some countries that, really kind of tax any investments and the interest rates on mortgages are higher. So, do kind of keep all of that in mind. If you're not in America, we're specifically talking about the U.S. I just wanted to add that caveat because I know we have a lot of foreign listeners.
Good call out. Okay.
So, yeah. And I will say, there's a lot of advice out there on why you should pay your mortgages off early, and people love to do the shock value of how much interest you save, but I actually really recommend, Student Loan Hero has a good calculator, and it's simply just an investment versus loan calculator, and you can put in your dollar amount, your interest rates, and how much extra you could put and see the difference for yourself after however many years you want to. So that's a really good one. I know they have one, or you could also just Google mortgage payoff versus invest calculator, and there's a lot of options out there. But this is a subject where I really, really, really encourage you to do the research because I know for years Brett and I were on the same page of we were going to pay our mortgage off in under 5 years was our goal. And now we're a year into our new plan of not paying the mortgage off, and I'm so glad we went this direction because I just feel like we are firing on all cylinders and we are going to reach our financial goals so much faster because we're doing this.
Right. I mean, we tried to do close to double payments or over double payments sometimes as aggressively as we could. We're tightening things down, really putting as much money as we possibly could toward it, to be extremely aggressive toward it. And we're not getting that money back. We don't have this opportunity anymore. So really for people that are just getting new mortgages and, are just getting into this or thinking about buying a house, please consider this, right? Because we missed out on 4 years of early, a ton of payments that we put toward the mortgage.
Right. Yeah. And I will say too, because I think the emotional aspect is strong. I will say I was so motivated to pay off my student loan debt, and I paid it off a year after graduating. I've talked about this on the podcast, I know, a million times, but emotionally, I made cuts that I might not have otherwise made because it was so motivating to be able to put an extra $5 a week towards my loans, right? Any money I could that went towards my debt payoff, it was super worth it. And then I kept doing the same thing with the mortgage, and I kind of had this fear of if I'm not in this extreme debt payoff mode where I'm like seeing these results, I'm going to backslide and I'm not going to save as much money, right? Because I think that's a lot of people's fear is like, oh, well, I can get my significant other on board because this is such like a powerful thing. But I encourage you to run the numbers and show them how much you can save. And I mean, something I always do that I don't know, we'll find out, I guess, if Brett appreciates it, but kind of every month I update him on like, this is what our, investment account's at, and of the money that we would have put towards our mortgage, but like, here's what it's grown to by sitting in an investment account. And for me, I find that just as motivating of like, let's get to the next milestone. Let's save, that next $1,000. Like, for me, that's just as emotionally rewarding as it was to pay off debt. So I think if you can make that switch and just start investing the difference, that's super fun to watch too.
Right. But definitely do one or the other, right?
Definitely.
Right. But it was easy for us to rotate because we were already in that mentality. So somebody that hasn't gotten into the mentality of like aggressively paying down their mortgage, right, it's probably going to be mentally harder to let that money go. Right. And so, writing it down and saying like, we're going to allocate this much money that we would have paid toward the mortgage toward, the investment accounts instead, and dedicating that money to it and sticking to that budget and that plan. That's one thing, but you don't have that primal driver, right? That is like, basically fight or flight for paying off that money on the mortgage in the first place, right, and redirecting that. So I understand it'd be a lot easier in the scenario we're talking about to, not invest this month and, spend it on something else, right? Because you don't see that really paying off the debt. But, where we do, we completely tie those two things together. We tie that monthly payment that we put toward the investment as paying down our mortgage, basically.
Absolutely. And I think, another big thing is to challenge yourself. So if you have not started investing any money yet, and you are otherwise debt-free. So if you still have credit card debt, I encourage you to, by December, come up with an extra $1,000 to put towards your credit card debt. Like, I'm challenging you right now. And if you don't have credit card debt, then I encourage you to save up $1,000 before the end of the year and get it in an investment. Because starting with that first $1,000 is so powerful. And I know a lot of you are going to be listening and saying, Angela, I just can't do it. Like, are you crazy? We're already halfway through October. We have 2.5 months left. But do it. I mean, just figure it out. Cut back. Like, how can you save, what do we have left? 10 weeks? How can you save $100 this week? And challenge yourself. I mean, it's not going to be easy, and maybe you don't do it. But the beauty is maybe you get close. Maybe you save $500 before the end of the year. And like, that's awesome still, right? So I think sometimes you just have to start, and you just have to take the first step, right? Like Brett said, for people who haven't been doing either or, paying down their mortgage or investing, you have to start somewhere. So why not start with $100 a month or $50 a month, or pick a number and make that your goal and see how you can save that much money? Because I promise you, there's fat in almost every budget. Not every single budget. We've talked about the poverty line on the podcast before, and if you're close to that, I understand. There's not much extra fat. But for our average listener, there's fat. Are you getting your hair cut before the end of the year? There's $50, right?
Right. Here comes No Shave November. So,
right. No Shave November. What about Christmas gifts? Maybe we're like too nerdy, but like, even if the first year we were dating, Brett was like, hey, instead of getting you a Christmas present, like, I'm going to get you, $50 of stock. Like, that's cool, right? So, I mean, Christmas gifts are a huge thing, though. Can you cut back on those? Can you talk to your family and say, instead of Christmas gifts, you want to spend time with them and, focus on paying down debt or whatever it is? Like, there's a lot of creative options out there. So maybe you pack your lunch for the next 10 weeks, right?
Oh, yeah, that's a big one. Yeah, whatever you do, just make sure to do something. Because investing a little bit now is way better than investing more later.
Right.
That's the way the math works out. If you can put whatever you can toward it now, and that it puts future you ahead of where you would be if you invested more amount for the rest of your life starting in a couple years from now.
And why is that?
Compound interest.
That's right. All right.
Yep.
So on that note, is there anything else you wanted to add?
No, I think that was the whole topic for today.
All right. Well, thanks for tuning in, guys. So I know this is kind of a crazy one, and people probably didn't believe me when they saw the title of Don't Pay Off Your Mortgage, because that seems like the opposite of something we'd say. But hopefully, after listening to this, you can kind of understand why we say that and why the math works. So, stop being emotional. I think this is something we always told ourselves when we were buying houses or rental properties. That's business, that's finance, and don't get emotional about it. Look at the numbers, do the right thing based on the numbers, and you'll actually come out way ahead in the future. So, right. Thanks for tuning in this week. Hey guys, thanks for tuning in to this week's episode of Money in the Bank. Make sure to subscribe to us on the iTunes or Stitcher app so that you get weekly alerts every time we post a podcast. Or if you want, you can visit my website, moneyinthebankpodcast.com. And if you want to reach out with any questions or further comments, please email me at Angie@moneyinthebankpodcast.com. I look forward to hearing from you. Money